Hey everyone, this episode's a little bit different than what we usually do. This is from a big chat that we had at this big conference a couple months ago. It's a bunch of different student loan experts just having an interesting conversation, and I thought it might be kind of a fun bonus episode for you to get to listen to in case you're on a long holiday drive or something. Hope you enjoy.
A 45-minute session on student loans. It's a topic that nobody on stage here needs any introduction. So we're going to start with introductions. They're going to introduce themselves. We'll get into a couple questions, and then we'll open it up to the audience for Q&A.
Awesome. All right. Hello, everyone. My name is Adam Minsky. I'm a solo practicing attorney focused on student loan law. My office is based in Massachusetts, licensed in Mass, Vermont, and New York. I've been doing this for over a decade, representing student loan borrowers and their families. I'm also a writer. I'm a senior contributor at Forbes, where I write about student loan stuff. Some of you may have seen my articles, and I also write for Student Loan Planner.
I'm Megan McGuire. My maiden name is Landris, so some folks might know me by Landris. I'm a senior consultant with Student Loan Planner and partner at SLP Wealth, and I'm a nerd about student loans, so I'm excited for today.
I'm Jay Fleischman. I've been a consumer, in general consumer, so bankruptcy, debt collection defense, and student loan law since, 27 and a half years. I practice in LA as well as in New York City. I go back and forth, and I turn it over.
Hey, yo, I'm Tate. I do student loan shit all over the country. Mainly we all pretty much do similar things. One of the things that I have a greater focus on, Jay and I, is discharging student loans in bankruptcy, and that'll be federal student loans, or for me, I primarily focus on private student loans and figuring out how to use bankruptcy to either get rid of them or reduce them down. Been doing this shit for over a decade. I think now. Decade, yeah, coming up.
That's it?
Yeah, dude.
I thought you've been around forever, man.
Dude, no, I clerked for 2 years, and then I moved into consumer banking. It's like, there's no fucking money here. I was like, okay, student loans. And at that time, it was basically you, Josh, and Adam, and then Travis came out the next year, and we bumped into each other in St. Louis. I was like, I could do this shit.
All right, so we're going to get started with our first question, and this is a question for Adam from the attorney perspective, to talk about, share with us where things stand with student loan forgiveness. That's something that on our side, as not attorneys, we talk about public service loan forgiveness and loan repayment programs, but just from Adam's perspective, we like to hear about other things with forgiveness.
Yeah. So obviously, student loan forgiveness has been one of the hot topics of the last few years, as I'm sure almost everyone in this room knows. President Biden's sort of broad student loan forgiveness program that would have wiped out $10,000 or $20,000 for most borrowers, obviously that was struck down by the Supreme Court over the summer. There's still a number of other Biden administration initiatives that are still in place and working for people. There are a number of waivers in place, in particular something called the IDR account adjustment, which can basically give borrowers retroactive credit towards a 25-year or 20-year loan forgiveness term under income-driven repayment plans. There's been some new reforms put in place designed to streamline access to other loan forgiveness programs like public service loan forgiveness, a disability discharge for folks who have medical conditions, and a program called Borrower Defense to Repayment, which allows borrowers who were misled or defrauded by their schools to request a discharge based on that school misconduct. Something like, I think $117 billion has been forgiven under these so-called targeted initiatives so far. Many of them are ongoing. $117 billion is a lot, but it's still a fraction of the $1.8 trillion in student loan debt out there. Now, while all that's happening, the Department of Education is moving forward with a plan to basically try to create a replacement student loan forgiveness plan to replace the one that was struck down by the Supreme Court. They're trying to do this under a different legal authority that they're hoping will withstand better judicial scrutiny as compared to the first one. This plan is being developed under a statute called the Higher Education Act, and long story short, it requires basically the Department of Ed to go through a long process called negotiated rulemaking, where they have to basically convene a committee and hold a series of public hearings and release draft regulations about what the program is going to look like. So it's going to take a while for that program to come out. But we're starting to get trickles of information that's sort of hinting at what it might look like. It sounds like they're going to be targeting this towards 5 broad categories of borrowers. These are folks who have some sort of extreme financial hardship, or they've seen their balances increase substantially over a long period of time due to negative amortization. They aren't able to qualify for or access any of the existing loan forgiveness program, or the cost of collection to the Department of Education would be greater than the amount that they'd be expected to receive in payments over a reasonable term. So they're still sort of hashing out what this is going to look like. It sounds like the soonest the plan would be available would be in 2025. That being said, the Education Secretary has some authority to try to implement some of those regulations sooner than that. I think it's too soon to know if we're going to see that happen, but not to get too political, but there is an election coming up, and so I think perhaps we might see some elements of this come into place possibly before next fall. But there was a set of hearings in October, there's another set of hearings in November, and then in December, and then I expect to see draft regulations on this new plan sometime possibly by the spring. And so I think we'll know more on where things stand with this within the next 6-ish months, and then we'll see where things go from there.
Adam, can I ask a follow-up question?
You may.
For the IDR waiver, because that's the big one
That's the big one.
Like
Yep.
all your clients. There's some concern about that being fully implemented before the administration, before the election cycle. Do you think the Education Department will get through the 43 million borrowers before kind of election cycle ramps up?
So a little bit more about the IDR account adjustment. So basically what's happening is the Department of Ed is running loan data through basically a computer program to identify past periods that can now count towards loan forgiveness that wouldn't have counted before. This includes many past periods of repayment, periods of deferment, and forbearance. What they're doing now is they're doing it in stages. So folks who have reached the threshold for forgiveness, either 20 or 25 years, they're being forgiven on a rolling basis every 2 months. And so we had a batch of borrowers get forgiven in July. We had another batch of borrowers in September. We're anticipating another batch of borrowers in November. It's approximately, I think, 855,000 borrowers have now received discharges under this IDR waiver. Everyone else who doesn't quite reach the threshold for forgiveness will still get all that retroactive credit, but then they're going to have to continue in an income-driven plan for the remainder of the 20 or 25 years that they have left. Those borrowers are expected to get that implemented sometime in 2024, and some folks need to consolidate in order to benefit from that, and that has to happen by the end of 2023. To Tate's question, we don't know if that implementation is going to happen at the beginning of 2024 or at the end of 2024 or sometime in the middle of 2024. I do think that it will be done before, January of 2025. At least that's what the Education Department has said. But they've also bumped out the timeline of this several times because of operational issues and funding issues with the Department of Ed. And of course, if something unforeseen happens, like the government shuts down next month, that could delay things even more. So yes, I think it'll be done in 2024, but I'm not going to say for sure it's going to be done in 2024.
I'd like to, and I listening to Adam talk is like reading the promissory note. It's wonderful. We're talking about the driest topic. We're talking about the driest topic in personal finance besides taxes, and he does make it entertaining. I'd like to take just a slight step back and relate the PSLF waiver. That was called the PSLF waiver, and it's been called the IDR waiver here on stage, also the IDR account adjustment. But if I could get a comment from one of our panelists about PSLF and how that's related to or still embedded in the current thing.
Yeah, I could take that one. So PSLF, Public Service Loan Forgiveness, it is for those working in nonprofit spaces or for the government directly as an employee. So that program has been around since 2007, but it has been challenging for folks to actually get public service loan forgiveness. There's been lots of articles about just the failures of that program itself, but they brought about what was called the PSLF waiver back last year. It expired October of 2022, right? We're in 2023, yeah. And it was basically a second chance for people to get credit for months that did not count towards PSLF, either because they didn't have the right types of loans or they weren't on the right repayment plan. People still had to be full-time working in an eligible employer setting, but it was a great chance for people to get that second credit and get a second chance at obtaining forgiveness potentially, or getting a lot closer. So that was a huge deal, and there was a mad rush for people to get paperwork submitted by that deadline, for people to consolidate their loans by that deadline. And then what we found out shortly after is it was technically extended through this IDR account adjustment, because all of the same terms, conditions, like rules that they were going to extend or kind of massage to help people get second credit, they're part of the IDR account adjustment. So now we have a longer window of time. I think one of the attorneys can probably speak to this, but one of the only differences is for PSLF, you have to still be working at an eligible employer right now to get the credit.
That's the big thing. Like the big takeaway of all this shit is IDR waiver is the big winner for everybody, right? Like broadly. But inside of there, there's PSLF for people can get retroactive credit. The PSLF waiver that ended last October, that's still kind of being implemented for some people who had their forms signed before or on or before October 31st, that's still in place as well. But those people who took advantage of the PSLF waiver last October and got their forms signed before November 1st, they didn't have to be working in public service any longer. So long as they had enough years of credit toward forgiveness, they could go ahead and get it. So that's still kind of lingering and working its way through the system. But broadly speaking, if your takeaway is anything, it's, oh shit, do I need to consolidate? Do my clients need to consolidate before the end of the year to get the IDR waiver? Because that's the big win for everyone. The pushback you're going to get is, what about my interest rate? What about capitalization? Bro, do you want this forgiveness or not? Like, that's what we're talking about. So, like, to me, that's the big takeaway.
Yeah.
And I think about it from the standpoint of, it shouldn't be why should I consolidate? It should be why shouldn't I consolidate? Mm-hmm. That would be the working framework I go into it with. Would you agree with that, Jay?
Absolutely, 100%. There are very, very few situations where consolidating an older FFEL loan or even some or a Perkins loan or anything like that, there are very few situations where it doesn't make sense to consolidate at this point. I can think of maybe one or two.
And it's like for me, it's like someone who wants to compromise a debt, right? And they have a lot of outstanding interest. And so they'll get a compromise where that'll waive a lot of the interest and they don't necessarily qualify for forgiveness. Compromise is term for settlement in federal student loans. And so someone who has a lot of interest, they're like, dude, I don't want to consolidate. I'm not going to get enough forgiveness credit. Cool. Can you afford a settlement here? Maybe that makes sense.
Exactly. That's exactly.
It's worth noting too, consolidation means combining within the federal system. I think there is a huge misconception or there's some terminology there that sometimes is confused with refinancing. So refinancing is privatizing the loans, taking them out of the federal system. That's a huge no-no if you want forgiveness or income-driven forgiveness. Or income-driven repayment. So consolidation is keeping the loans federal, and that's what we mean when we're talking about consolidation.
I'd like to
But at
piggyback
the
off
same
of that
time-
for Jay.
Hang on one second. But at the same time, it's kind of like in The Princess Bride, that word doesn't mean what you think it means. The term consolidation is a legally defined term, and it doesn't mean what you think it means. In the real world, when we talk about consolidation, we're thinking more like debt consolidation, right? I'm going to take 5 credit cards, I'm going to put them in a bundle, and I'm going to administer them together. But if I look inside the bundle, I'm still going to be able to see those 5 individual credit cards. That's not consolidation when it comes to federal student loans. Consolidation when it comes to federal student loans is the process of taking your existing loan, giving it to the Department of Education, and they give you a brand new loan. It's a crumpled one. When I was a kid, I grew up with 0 money. So my grandmother, one of the ways to keep me entertained was she would take a crumpled $1 bill, and we would go to the bank back in the day when you went to the bank, and they would give a brand new $1 bill. That's consolidation for federal student loans. So when you're thinking about consolidation, don't think of it in the way that we think about consolidating other things.
Oh, thank you, Jay. Yeah, I actually want to keep you talking on this one. So everybody up here has written about the SAVE plan in some form or fashion, but I'd like to just hear from Jay about the SAVE plan, the Save on a Valuable Education plan that was announced this year, went into effect this year, and how it's different from the other income-driven plans.
Sure. The SAVE plan, I think, next to the IDR adjustment, I think that the SAVE plan is quite possibly the best thing to come out of this entire thing. The SAVE plan is an income-driven repayment plan that allows the borrower to have their monthly payment adjusted based upon their current taxable income minus a baseline that's tied to the federal poverty level. And in that broad sense, it is exactly like all of the other income-driven repayment plans. But it establishes, number one, a higher baseline. It's 225% of the federal poverty guideline for a family of your size, as opposed to 150%, which is the other income-driven repayment plans. Number two, there is a cap on your interest, and your interest isn't going to capitalize. So if your monthly payment does not cover the amount of interest that accrues on a monthly basis, the uncovered interest doesn't accrue. So your balance is never going to go up. So even if you've got a $0 monthly payment, if you owe $500,000 and you have a $0 monthly payment, in 20 years, you'll owe $500,000, presuming that you remain compliant with the SAVE plan and you don't switch from one plan to another. That's the second thing. And the third one is under Repay, which SAVE replaced, Repay forced married couples to make the very difficult decision of checking a box that said, I can't reasonably access my spouse's income, file separate, and essentially put down a Maginot line between the husband and the wife. And that was difficult for a lot of people, number one, to wrap their heads around, and it really changed the dynamic of the marital life, I think. And under the SAVE plan, so long as you file separately, yeah, you can't use your spouse as counted towards your family size, but you don't have to certify that you don't have access to your spouse's income. And that changes a lot of things for a lot of, at least my clients.
I mean, there's some clients who are like, does everyone know what we're talking about, this reasonable access shit on the form? Like, all right, cool. So on the income-driven repayment form, there's like 4 boxes: single, married, married but separated, married but can't reasonably access my spouse's income information. What the hell does reasonable access to my spouse's income information actually mean? The rulemaking authority says like it's basically supposed to cover like domestic violence situations or like financially abusive relationships. In practice, what has happened is services will be like, yo, just check the damn box that you don't have reasonable access. And then you lose your spouse from your family size, but then you gain the ability just to look at your income alone. And so in practical purposes, that works out great for families. They're like, shit, I ain't got to include my spouse's income in this, and I get this lower payment? Sign me up. But then you have some ethical people that are like, yo, I'm signing a form, I could go to jail. I'm lying on this form. And that posed a huge issue for people because like there's a lot of harangue behind it and it doesn't feel clean. Or there's like a worry buried inside of there. The government's going to look up and I get to the forgiveness finish line and they're going to tax me for all this shit because they saw that I was lying on this form. Or year before I did jointly, but now I'm saying I'm filing married but can't reasonably access. They know I'm lying. And these concerns and this this monkey brain just eats at them. But in reality, it was never really that huge of an issue. However, I don't find that there can be a justifiable reason to use it going forward now that the forms have changed, because previously your spouse had to sign the form no matter what. Now it's just not even there's no signature.
In and of itself.
But I think you had further justification back then because, dude, my spouse doesn't want to sign this. Like, what can I do? I can't force them to sign, and I can't use a tax return without their spouse, without the signature. I think you had greater justification then. I don't know that there's any justification now because they eliminated your spouse having to sign the form.
One thing I just want to, I want to tie in this discussion about the SAVE plan real quick with the prior question about consolidation and refinancing. One of the things that we see, that I see, and one of the things that I say to people who are not familiar with student loan stuff is that student loans are weird. It's different from other types of debt in so many ways. For most types of debt, what you want is to get the lowest interest rate, right? Because it's gonna help you pay off the loans more efficiently and save you money in the long run. But because of all these programs, the interest rate just doesn't matter as much when it comes to federal student loans. And so, one of the things that I hear from some people is, hey, if I consolidate, it's just the weighted average of the interest rate. There's no interest rate benefit to consolidating with a federal direct student loan. So you're not saving any money interest rate wise, but because of this massive interest subsidy that comes with the SAVE plan, where they will waive any excess interest that exceeds your monthly payment, it operates effectively as an interest rate reduction if your payments are going to be underwater relative to interest accrual. It's such a huge benefit. And like Jay said, if your payment is zero, that essentially means you have a $0 payment and $0 interest, which is in many ways an extension of what we saw for 3 years during the COVID pause. If you refinance the loans into a private loan to get a lower rate, you forever lose access to SAVE, loan forgiveness, and all the benefits. And that's just really important, I think, for folks to understand. And if you're not, steeped in this stuff like a lot of us are, you might not realize that.
Dan, let me just, I'm stepping all over this shit. Here's the thing. There's a numbers aspect of this that makes perfect sense. I get a loan, and if I don't pay anything, my payment is zero, it never grows. But I don't know that we talk enough about the emotional impact it has on someone to say, okay, I'm not paying anything and the balance isn't growing, because some people have this emotional trauma, but watching their balance grow. And that scares them and it freaks them out. So now you have a situation where you have to wrap your brain around something else. I may pay $500 a month. That means I pay $6,000 a year, and my balance never goes down.
Right.
But it never goes up.
And you're making progress toward loan forgiveness.
But I think that framing it that way changes the mentality behind it. Because I am saying, yes, you're going to pay this money, and unlike your credit card, unlike your student loan, your house note, unlike your mortgage, it's never going to go down. But it will never go up. And unlike any of those other debts, it will be forgiven.
And if you're worried, take a little extra money. This is what I tell my clients. Work with a financial advisor, who is not me, and invest that money. And that can serve as an emotional balm, so to speak. It can serve as what I call a risk mitigation fund. Some people are like, well, what happens if they take this away? Or what happens if my circumstances change and this plan no longer makes sense? Well, if you have smartly and consistently set money aside, it can serve as a risk mitigation fund. Also, people are understandably very concerned about the tax bomb at the end of loan forgiveness. There is a temporary waiver in effect on that expires at the end of 2025. It's going to be up to Congress as to whether to extend that or not. But that so-called risk mitigation fund can also serve as a possible future resource to cover the tax bomb at the end as well.
Well, and I think too, I think all of you guys here speak to folks who have student loans. You guys have an audience where there is a pain point, and student loans is that pain point. And this is all overwhelming. All the words we're saying right now is a lot. So I think one way we can maybe break it apart into something digestible that you guys could share, that makes sense and that puts people in the right direction, is when it comes to repayment, it's either we're doing a payoff approach or we're going towards loan forgiveness. Yes. It's nowhere in between.
Yep.
If we're somewhere in between, then for example, if we're on an income-driven plan, but we're paying extra, we're not really benefiting the most we can from that forgiveness path. Because why would we pay extra if we're going towards loan forgiveness? We're throwing money into a hole.
Yeah, but if what you're saying there breaks every other debt payoff rule, right?
It does.
Exactly.
But that's the thing. You have to frame it that way. There is no fucking avalanche. There is no snowball. Dude, choose a path, bro. That's it. And once you choose it, you can flip when life changes.
Yeah.
If it makes sense for you financially to flip. And usually that's for higher earners. It makes sense to flip. For the rest of us broke ass people, it don't make sense. Just go down the path and accept your fate and just keep going.
All right, so on that note, we haven't talked about, I'd like to just put ourselves in the shoes of a borrower who hasn't had to make payments since March 13th of 2020 and has to make a payment for the first time this month, and is maybe on an income-driven plan, but is looking at their budget and going, I can't make this work because of X, Y, or Z. So I'd like to, in response, just tell us about how a borrower goes from today to potentially in default down the road, how does that even happen, or could it happen in the next 12 months?
I could touch on that initially. So the repayment is supposed to be starting this month. There's been a dumpster fire of a mess with all the servicers right now trying to get organized and get people on repayment. So a lot of people are in what's called an administrative forbearance, where they said, hey, we need a break to figure out all these applications that we got for repayment. So if you're working with someone, or you know someone who's trying to get into repayment, their payment is too high right now, they can reapply, or they can switch to save, which may be a cheaper income-driven payment. They may have old income on file, that maybe their current income is a better representation of their current, their situation. So that can make their payment lower. But if they still cannot afford what's coming due soon, one route, they have what's called the Onramp to repayment. That is, this is going to sound crazy too, but essentially you just don't pay. This is what the Department of Ed is telling you to do. Just don't pay, and they'll put a retroactive forbearance on your account. The only issue with this is they even say on the Department of Ed website that they can't control how creditors will look at this. So that's problematic. So you can ask for an administrative forbearance, but you're going to have to sit on hold for a while. Do you have a question? That's what they originally said. Then they put in a little sentence on the Department of Ed website. I don't know why. Do you have an idea?
Well, yeah. So here's what's happening. So the Department of Ed is not going to report a missed payment as delinquent to the credit bureaus. So that is what the Department of Ed says. What the Department of Ed did is they updated the guidance on their website to basically say, we're not going to report it as delinquent, but we don't control what the credit reporting agencies do. And my understanding of what's happening behind the scenes is, it's not that they're afraid the credit bureaus are going to report it as delinquent, but they might, show the balance increasing because of interest. Because if you're not in the save plan, you're not getting the interest subsidy, or they're not able to control how a future lender will look at that if it shows that a payment isn't being made when a payment is due. So they're basically trying to hedge against some indirect or unforeseen outcomes, but it should not be reported as delinquent, and it is impossible to default over the next 11, 12 months under this on-ramp.
Right. So when would that come up? Like, dude, if you're in a home buying process, you have a payment, but you're not showing a payment being made.
Yeah.
I think that's the real concern there of that particular section. But remember, credit reporting agencies, it's voluntary what you report into there for the most part, right? They have to report it. The government's saying we're not reporting anything. But then the credit bureau can still kind of like say, no, we pulled this public information, whatever, and just report it somehow. But there's not going to be any late payments, but I think the real impact is going to be home buying type situations.
Yeah. So let's fast forward past this on-ramp forbearance. How does a borrower come to find themselves in default? What are their options? And start from, they're at month 0 right now. They haven't made a payment. The payment's been missed. It's now delinquent on day 31.
I can jump in. Or Jay, you want to jump in?
You can talk.
So historically, there were 3 main ways to resolve a defaulted federal student loan. There's a program called Rehabilitation, which is basically a 9-month payment plan. There's Consolidation, which we've already talked about, the same program that can help people access the IDR account adjustment. There's Compromise and Settlement, which Stanley referenced. Right now, there's a special program in effect called Fresh Start. And during this Fresh Start period, if you are currently in default, there is no collections activity for another year. And during that year, you have the opportunity to access this Fresh Start program, which essentially involves you giving the Department of Education a call and saying, hey, I'd like to get out of default through Fresh Start. And they're like, great, you're out of default through Fresh Start. I mean, that's basically how it works. It's a little bit, obviously nothing is that simple when it comes to student loans, but that's essentially, right? It expires in a year. And once that year ends, we go back to the prior system of default and collections, which many of you might know is pretty awful. They can garnish your wages, they can intercept federal tax refunds, they can offset Social Security, they can tack on enormous collections charges, upwards of 25% of the balance. So basically, you have this 1-year grace period to get your loans out of default. You can still rehabilitate, but there's no real reason to do that in my view. You could consolidate, and there might be a reason to do that if you want to access the IDR account adjustment or public service loan forgiveness or save. But Fresh Start is this other route. And what's important, we haven't really gotten into this. This is super in the weeds, but some of you may know there's a difference between direct federal loans and FFEL loans, which is an older guaranteed loan program. Fresh Start is available for most loans in both categories, with some exceptions.
Okay, so we have 12 minutes. Let's start with questions.
Yeah.
Questions, Nadia, and then.
Now, this would show my ignorance with student loans, but you're mentioning all government loans, but what about the people who have private loans
Yeah.
or refinance the loans to the private sector?
Oh, it's a shit show. It's a shit show. Well, I love this because for me, it's money, right? I get paid, because interest rates have risen on a lot of these variable rate loans, and people were ignorant to pay attention to rates rising, and they didn't refinance or switch over to a fixed rate, right? So now they have upwards of 19% interest rates on a $150,000, $200,000 loan. And there's no options. Let's be clear. There are no options. And if you have been on some type of forbearance, you ain't going to be able to refinance. It's done. So what the hell do you do? And I love this because I get to look like a fucking superhero. Because I come to it, I'm like, hey, look, can you afford a settlement? Most lenders are going to have settlement parameters that you pick up on around the way where it's going to be somewhere between 40 and 70 cents on the dollar. Sometimes in a lump sum.
If you were in default, though, that's
well,
an
but
important
yeah, you're
distinction.
gonna. Well, that's the thing. Sorry, let me back up. You at a certain point, you're gonna have to make a choice with a private student loan. Can I keep up with this payment? Yes or no. If I can't, what are the bad things that happen to me? And a lot of bad things don't happen to you until you default and then you are sued, which generally it's not a short window of time. It's usually a year, 2, 3, 4, 5 years that are involved there. And so in between the window between when you default and when you are sued, there's a huge opportunity to negotiate a settlement potentially. Now, obviously, the lender doesn't have to take that, but it's in their business interest to do so.
Sure.
Mm-hmm. And then if you can't afford a settlement, what do you do then? Well, you can move your ass out the country, right? or you can use the bankruptcy process, and this is what I love, because it's so simple. You file bankruptcy, and you're like, oh, I thought it was hard to get rid of student loans. Number one, the question really isn't, can I get rid of the loans? It's, can I use this tool to get a better deal than I could otherwise get? Mm-hmm. And so I file an adversary proceeding. Sometimes I'm not trying to get a full discharge because I know there's a cosigner involved. I don't want to leave the cosigner on the hook, so I want to negotiate a settlement that protects both parties, right? And to give you framework, I just did one last year. Lady owed $480,000 as a public school teacher. Mm. It's crazy, but it exists. There are no settlement options, but we used bankruptcy, and we ended up settling for $80,000 over 20 years at 1% interest. That's a win. Mm-hmm. Yep. Right? And the only reason why it went that long is because she had like $300,000 of equity in her house. So it's like, I got to do something here to give them a bone. That happens. Or I just did one yesterday, we just finalized it yesterday. Veterinarian, she makes $16, not a veterinarian, but she's a vet tech, $16 an hour. She owes $200,000 in student loans right after graduating 3 years ago. She can't afford these. She makes $16 an hour. The girl told me a night out in the town for her is going to Cheddar's and getting a damn Buffalo Caesar chicken wrap with extra hot sauce. And I felt so sad for this woman. Because if that is the highlight of your damn week, good Lord. But it was for her. But then we used the bankruptcy process, and they agreed to wipe out the entire balance. And it took 5 months. What about my credit? Fuck your credit score. It's going to be back inside of 2 years.
Yep. All right, so question back. One question back here.
Yes, and I think you may have answered it. My client, she may have been sued. I had a client who called me about a month ago and said that the sheriff showed up at her home from her student loan. And I was like, I've never heard of the sheriff showing up. And we really didn't get anywhere with it, but I wanted your take on that and maybe kind of what that was.
Yeah, your client was getting served with a summons and complaint that sounds like the initiation of a lawsuit.
Yeah, in most states, it's not like it's not like TV where they're like, you've been served. Like someone just drops it off, like usually a sheriff or a constable.
Yeah, and to the bankruptcy point, you can't understate the amount of leverage that you get against a private student loan holder in bankruptcy, because as scary as bankruptcy is for the borrower, it is just as scary for the lender, right? And when you've got a private student loan in default, you are typically, at least in my jurisdictions, I don't know about you guys, but you're typically going to deal with the exact same law firm that is doing the credit card collection cases, which is a very different animal, much lower stakes, and relies just on volume. So you're going to get, and I hate to speak ill about other attorneys, but hell, everybody else does, you're getting a lower level of attorney. You're getting somebody who doesn't really have, they often don't have a direct line to their own client. So they've got to go to their national counsel. The national counsel's got to okay it. They're basically a puppet. They're a local puppet. You go into bankruptcy, now you have somebody who can actually sit down at the table and do a deal with you, and who's got direct access, and who also doesn't want to be the one who pees in the pool. Because everybody knows that getting a discharge of student loans in bankruptcy can be an uphill battle. And nobody, particularly the big company that we all think about when we think about private student loans, NAVI, fill in the rest of it, they don't want to be put in a position where they draw a line in the sand, they say, screw you, we're not going to do anything, and you don't want the judge who's got a ton of time on his hands and has an axe to grind, because one judge's good outcome for our clients is horrific for Navient, and we just saw it in those cases out in New York.
I just want to push back a little bit on my friends, because I don't do bankruptcy, but I do defend a lot of private student loan lawsuits. And I just want to make sure we're being clear that it is very possible to also get good settlements without going through the bankruptcy process. And to your...
100%.
Well, I agree with you
100%.
only if that person's being sued.
Right.
Because if they're being sued, and this is like the weeds of it all, but let me bring it up. There are different settlement buckets that you can get depending on where you're at in the process. If you have not been sued, but you have defaulted on your loan, typically a lender won't go, or a debt collector won't go past 5 years is the longest I ever see, but generally it's like, give me as much money in the shortest amount of time as possible. You get sued, and in state court, in Adam's world, you may get a deal where it's a significant reduction in a longer period of time. Does
And
that
no
happen for you?
interest.
It varies, but you're right. It does matter where it is in the process. Also, even in the context of a private student loan suit, there are sometimes defenses you can raise based on, say, the debt was transferred like 10 times and then have the documents to prove it. My point for your question, though, because you said you have a client who got something from a sheriff like 30 days ago. So number one, there are deadlines to file a response, and if you don't file a response, you've lost the suit, and you've lost the ability to defend yourself, and now you suddenly have far less leverage to negotiate that settlement. Most of these volume-based debt collection law firms that Jay was referencing bank on people not responding and getting a default judgment. So that client or that client's son needs to lawyer up ASAP, because even bankruptcy or not, having an attorney and responding to the suit at a minimum buys you time and preserves your ability to get an outcome that might be doable. Ignoring it and just thinking, oh, this is nothing, is like the worst thing you can do, and that's exactly what the student loan lender and their attorneys want you to do.
Is it usually 30 days, 60 days?
Varies by state. So in Massachusetts, where I litigate, it's 20 days after being served with a summons. You've got less than 3 weeks. Now, you can ask for an extension, but you got to ask for an extension, usually from the court or through an agreement with counsel. Other states, it's 30 days, but it's not a lot of time. You got to move fast. When you get that summons, you got to move.
And then you're moving fast, and you can't find any help because there are very few people who do this type of work.
Yeah.
And so I get calls, and I'm sure Jay does, from all over the nation, like, dude, I'm being sued in North Dakota. What the fuck you want me to do? I can't help you with that.
I'm going to give you a resource, because we're only licensed in certain states, and so we can't litigate in every court in the country. There is a National Bar Association called the National Association of Consumer Advocates, NACA or NACA. Their website is consumeradvocates.org. They have a directory on their website of attorneys who specifically focus, not necessarily only in student loans, but in consumer litigation in general. Some do debt defense, some do credit reporting issues, some do, unfair debt collection practices. But my point is, that's a great resource if you're not an attorney yourself to direct someone to find a local attorney. They have a directory on their website. You can narrow by state and specialty. That's a really good place to start if you need a local attorney to help your client.
Thank you, Adam. One more question over here I had, and we've got 2 minutes to answer this one.
Okay, I'll make it quick. So, Adam, earlier you mentioned the administration's new approach to student loan forgiveness, using the Higher Education Act as legal basis. Now, in your opinion, hold on. So it's going through the formal rulemaking process, right? Which didn't happen before under the
HEROES Act, yep.
Okay. So, in Kayla's opinion, is there still room for legal challenges, and do you see this back in the Supreme Court?
This will absolutely be challenged. This will absolutely go back to the Supreme Court, in my opinion. I'm not super hopeful that it'll,
Did you see Jay lean back and crack? He was I got this. This right up your alley because you did the video in your car where you're talking about this is like all you, baby.
Yep, absolutely. The Higher Education Act already specifically allows the Secretary of Education to compromise debt up to, what is it, like $1 million?
Up to $1 million.
Some ridiculous amount. But I don't think that the current administration wanted the 10,000, 20,000 to go through anyway.
Yeah.
He was pushed up against the wall. He mentioned it during the campaign. He won. He said, I won. They said, how about student loan forgiveness? He said, what? Did I say that? Like, he did not want to do it. And you've got to remember, and he's been pushed to the left on a lot of things, and he's been great for a lot of reasons, but he was the senator from MBNA, if anybody remembers that company. That's what he was. He's a banking lobby guy. That's what he does for a living. He did not want to give up money. It's also really, it's a bad look in Congress. Hey, you gave away our money. So I think that this was done kind of as a throw it up against the wall. They knew that it was going to get, challenged. They knew that it was going to get struck down. They were totally okay with it. If he had wanted to do it the right way, he would have used the Higher Education Act in the first place. That is there, and it's the same law that permits the compromise of defaulted federal student loans.
Yeah, but that don't play well during midterms when I'm trying to win, baby.
Yeah, exactly.
So I need this 10 to 20,000 that we can get voters behind. But the Higher Education Act is a longer process.
Yep.
Will it challenge? Absolutely.
Yep, absolutely.
I do think it's on stronger legal footing. I
Absolutely agree there.
absolutely stronger legal footing. But what happens at the Supreme Court? I don't know.
Sure, and the follow-on problem to that is the fact that one of the major reasons why the servicers are having so much trouble in this new repayment cycle is there's no funding, there's no money in the pot. Congress has held the Department of Education hostage over this, and so even if they're going to use the Higher Education Act, that is administratively so much more cumbersome. They're just not going to be able to handle it. And my concern is that this is just going to turn into the borrower defense cases. And you're going to have stacks and stacks. I envision stacks and stacks and stacks all over the place, and nobody's there to handle it.
My feeling is we're going to look back on this period of time and be like, what the fuck? Right? That this is truly a black swan event from a student loan standpoint. I don't foresee a future where we'll see this type of forgiveness anytime soon in the future, that this is a one-time thing, and there are going to be people that miss out simply because they put their head in the sand and they didn't get the loans forgiven. They're going to be pissed off, and you're going to be like, tough shit, you had 2.5 years to get through it. But I just think this is it.
And just to kind of close this all up, I think your job, all of you, if you work with clients who have borrowers, is to yank their heads out of the sand and make sure that they are aware of these programs and these opportunities, because they are new, they are time limited. You cannot rely on servicers to get this right. We need all of you to help spread the message about these programs so that more people can take advantage of this while they are available.
Yeah.
Awesome.
You don't have to know all the technicalities, but point them in the right direction for where to go.
All right. So we asked 7 questions in 45 minutes. That's great. We could go on all day. Let's give our panelists a round of applause.